This is John Paulamy of the Actionable Intelligence Alert. Today is Sunday, April 15th, 2018. And today I wanted to talk about some action that we had last week in the offshore oil drilling stocks that has really piqued my interest. As listeners and readers of my website know, I'm very bullish on the oil price this year based on supply demand fundamentals that I think that are contrary to the pervasive narrative that the price of oil will stay lower for longer. I've laid out those reasons why I think that's not true and why I think the oil price is heading higher. And this week in the stock market, we really saw some big action in the offshore oil drilling stocks. Just about every single offshore oil drilling stock moved higher, substantially higher, and has been for the last couple weeks. So I wanted to go over what happened this week in the oil drilling stocks, the offshore stocks, and also reiterate the reasons why I'm so bullish on this particular industry. So just to review a little bit of why I think the oil price is heading higher and why I think offshore oil drillers represent an excellent opportunity to take advantage of that. This is a chart that I got from the Transocean recent presentation they gave. And basically what it is it shows global oil reserve replacement for the last 20 years. And what you have on the left side of the screen is the total amount of discovered barrels of oil in billions. And on the right side of the screen, what you have is the ratio of discovered barrels to produced barrels. And we've talked about this before. And this chart really, I really like visuals because visuals really drive home the narrative instead of just me saying, well, we've used up more oil than we've produced for the last 20 years. And as you can see from this chart going back 20 years, there's only been 1 year, and that was 2006, where the oil industry found more oil than it produced. I mean, this is stunning. And then if you look at from 2006 on to 2017, it's basically been in a huge downtrend, culminating with last year, where the oil industry only replaced 9% of the barrels that it produced. I mean, this is crazy. And if you look at even this time frame from like 2010, 11, 12, 13, you can see that even in these times of sustained high oil prices, when the oil price was nearly $100 a barrel or over $100 a barrel, the oil industry was still not replacing the barrels that it produced. So, as I've said before many, many times, the oil industry is an extractive industry. So, if you're pulling your product out of the ground and you're not replacing it, at some point you go out of business. And this chart reflects that. So, I think this is really illustrative because several things kind of come to mind here. Why isn't the oil industry replacing the reserves or replacing the production? Is it just because it's so oversupplied, or is it that it's getting more and more difficult to find large deposits of oil? And I think that's really the case. I mean, I'm not a peak oiler. I believe if the price goes high enough, demand would be choked off, alternatives would come into play, and every single ounce of oil in the ground would be produced. So I'm not one of these people that freaks out about these things. I'm not a Malthusian that thinks the world's going to end and we're going to run out of, oil. But what I do sense is that this really kind of tells you why we're going to be heading for higher prices. You couple this with the fact that demand is increasing. This is without a doubt. In fact, the IEA has had to raise demand forecasts several times already this year. And we're now up to demand growth of 1.8 million barrels for 2018, above last year. So you couple this with a depletion of 5 to 6 million barrels a day, and you're having to find the equivalent of a Saudi Arabia every year to replace the oil that's being produced. It's not happening. So my longer term thesis, of course, is I think that the world economic recovery is not going to be choked off because of debt or or these other things that a lot of people talk about, interest rates. I think it's going to be choked off by high oil prices. I think the oil price is going to go substantially higher over the next 18 months, and like it did in 2007 and 8 when it got up to $140 a barrel. And the world economy simply can't sustain that high level of oil price. And I think that's going to happen again. So this chart really needs to get seared in people's minds. We're not finding the oil, we're not finding enough oil to replace the oil that we're using. And demand is really increasing. So I think this sets up for, in the near term, when I talk about cyclicality of this industry, and specific to the oil services stocks, this sets up really well over the next 18 months to 24 months for some really extraordinary gains. Now, as it pertains to offshore oil, this is a chart that shows the break-even oil price for various projects in the Gulf of Mexico. And you can see that the break-even price is about, if you average all these projects, it's about $50 a barrel. And there are quite a few projects that are substantially less than $50 a barrel. So what this tells us is that when you're an oil company and you are managing resources, you have to think in 3 to 5 or 10-year periods to deploy capital. And if you have projects that are, $50 a barrel break even, and you have an oil price that's now, at least West Texas Intermediate's pushing 67, Brent is over $70 a barrel. And as the time goes by and these prices don't pull back, it gives these managements more confidence to move forward with these multi-year projects. These projects take many years, several or 5 or 10 years to bring to fruition, to go out and drill the well, build the infrastructure, bring the project online. So I think that there's this misconception that offshore oil is not competitive with onshore oil, like in the shale plays, and that's kind of discounting, I think, the whole industry, and especially the offshore drillers, because people think, well, it's so expensive and no one's going to go out there and get this oil because we have this shale oil that's so cheap and plentiful. And I think this is just one region. This is the Gulf of Mexico, but this is, I'm sure, it's pretty standard around the world where you have projects that are actually quite competitive at the current oil price. And we have to remember something about oil companies. They're in the business of producing oil. They know they're an extractive industry. They know they have to replace the reserves. They know they have to bring on additional production. And they are doing constant cost benefit analysis and internal rate of return calculations on these projects. So if they feel that the project, if you have some of these projects that are $30 or $40 a barrel break even, and the current oil price is $67 or $70 a barrel, and they feel it's going to be sustained, they're going to move forward with the project. They can make the case in their internal economic calculations to justify moving forward. So this you couple this with the fact that cash flows are going up, and the fact that currently the offshore oil drillers are underemployed, that kind of all comes together, gels together. I mean, if you're looking to get infrastructure for offshore or services, the costs are relatively cheap in the cycle because there's so much supply out there of rigs and workers and different things that you need, resources to drill and complete a well. So that goes into your economic calculation also, and makes it more likely that you will move forward with these projects. So I think this chart really goes to the main point here is to show that offshore is not to be discounted. And I think a lot of people do that. They just figure, well, it's high cost oil and no one's going to produce it, so let's just write off the offshore oil industry. People forget, and this is another stat people need to keep in mind, 30% of oil, the world's oil, comes from offshore. That's not to be discounted. It's not going to be readily replaced by just shale plays or onshore oil. It's not going to happen. So offshore oil has a place. It will remain a significant contributor to world oil supply. And we have to remember something. What are oil companies in the business of doing? Producing oil. So if they get increased cash flows from a higher oil price, They are going to recycle it back into new production. It's going to filter down into the service stocks, the offshore oil stocks, and we will see that's how the whole cycle, starts over again from the bottom, which we're at now. I want to remind people of this chart also. This is from the recent ENSCO presentation, and it shows the last 6 up cycles since 1985. We went over this before, and you can see the extent of the time frames: 17 months, 34 months, 22 months, 28 months of the previous up cycles, 40 months, and you can see every single downturn that has happened in this industry has at some point turned around, bottomed, turned around, and went back up. So we have to remind ourselves of the cyclicality of this particular industry. And you can see the most recent down cycle has been one of the worst of all time. So what are the odds that this cycle doesn't perform like the previous cycles? I just don't see that not happening, guys. I see the cycle performing like the previous ones because nothing really changes in the economics and in the minds of the actors in the industry. As cash flows increase, like I said before, they're going to try to increase production, try to replace reserves. So I think we're at the bottom of this, the bottom's in on this last cycle, and we're moving higher. And I think this last week action in the stocks confirms that. So let's go over a couple of the players in the industry and just take a look at some of the charts. Okay, this is our friend ENSCO here, and as you can see, this is one of my favorite stocks. And I'm going to be honest with you guys, I am really increasing my exposure to the offshore oil drilling industry. I'm going way above my normal allocation just because I see this is really setting up really nicely. And, obviously we could have a worldwide depression like 2008, a psychotic break in the markets, and a big, decline in world GDP. And obviously that would affect world oil demand. But I just don't see that on the horizon. No one's forecasting that. No one's seeing that. Of course, you could see a black swan event. What we're seeing is increased global growth. Yes, it might be slowing down a bit, but we're still seeing growth. That means increased energy demand. That's why the EIA or the IEA has continued to have to raise its demand forecast this year. I mean, oil demand just continues to increase. It's coming out of these really emerging and frontier markets. Everybody talks about China, but no one talks about India. India has 1.2 billion people, and it's just now entering its S curve for commodity demand. And I'll be talking about that some more in the future, but we just can't discount 1.2 billion people plus the other close to billion people in the rest of the Asian countries ex-China that are really kind of being ignored. Some large populations that are just now getting wealthier and wealthier and increasing their energy demand. So if you want to look at some technical analysis here, you've got a double bottom. It looks like here you've had this big price spike last week on a relative RSI, relative strength. Lots of room to move to the upside there, looking very positive. Here's Transocean, another one of the big players. And here we see the same thing. We see a bottom back here last year in August. Made a high, made a higher low, and here we are. Look at the trend. We've got a trend that seems to be moving positive with a big breakout last week. Look at the accumulation distribution. We've got this moving positive now over time. That means people are accumulating this stock. This is when people are selling the stock. They're getting rid of it. But look what's happening here since last August. You've got people accumulating the stock overall. Here's Diamond Offshore, another offshore oil producer or driller. Same thing, guys. Last August, that was the bottom. Here, what do we have here? We have another big thrust higher last week. Big push, big money coming in. Look at the accumulation distribution. Not as strong accumulation as Transocean, but people are accumulating the stock. And here's Tidewater, which is not an offshore oil driller, but it is a service provider, and what they do is provide boats and transportation out to the rigs. So they have these boats like called row boats, roll on, roll offs. They take supplies and personnel out to these rigs, and you can definitely see what's going on here. This thing was in a big, this thing went bankrupt. This company reorganized, and it was kind of going sideways for well about a year here after it bottomed, and now we're seeing this action where it's starting to break out to the upside. You're seeing the moving average kind of flattening out now. You're seeing, look at the accumulation distribution. I mean, somebody's in there buying the stock. They see the turnaround, guys. So to sum up, we've been talking about the oil industry. It was a theme of 2018 that we thought the oil price would be heading higher. From that original thesis or thought, the question is, how do we best take advantage of it? I don't think it's best to just go out and buy oil producers. Yeah, you're taking on a lot of risk when you're doing that, but this industry right here has shown in the past that every time that the oil industry bottoms and begins its recovery, it does exceptionally well. So I think the time, if you haven't taken positions in these stocks, I think that you should really analyze what's going on in this industry, pay attention to the earnings reports, listen to the conference calls that'll be coming out here. The first quarter earnings should be in. What we're looking for is, we're not going to be seeing this. I don't expect to see the management saying, "Yeah, everything's going great guns," but what you should see is gradual recovery, gradual improvement. Like we've talked about before, what do we want to see? We want to see something that goes from terrible to very bad to less bad. And that's what we should start seeing. We should start hearing about increased inquiries from oil companies, higher utilization, rig utilizations, maybe even some more contracts coming online. So that's what we'll be looking for in these first quarter earnings reports and commentaries from these management teams. And I think that's what we're going to hear. But definitely the price action in the stocks, guys, let's just look at them real quick again, is all seems to be positive, and it looks like money is starting to come into these companies now. I mean, we've actually even heard research firms like or investment banks like Goldman Sachs and Credit Suisse both upgraded several of these companies in the last couple of weeks and came out with upgrades to the stocks and higher price targets. Take that for what it is, but if they're doing that, that means they're pushing their customers into these stocks. And that's what we want to see. This go from, like I said, less from bad to less bad. So that's it for this week, guys. I encourage you to take a look at these companies. I think there's an excellent opportunity here. And I think that out of, what I'm really looking for, which would really line up really nice, is for this oil market to really turn around during 2008 and for us to make tremendous profits. A large amount of the profits made in these moves is made on the very beginning of the moves, as these things break out to the upside. So if you don't have a position in these, really take a look at it and consider this, because I think that there's going to be a tremendous amount of money to be made in the offshore oil drilling stocks. That's it for this week, guys. Thanks for listening, and we'll talk to you next week.